Good morning and welcome to Getting Started with Options. Today we are talking about the basics, the very beginning. So how to get started trading options, what are they all about? Some of you may have heard conflicting stories. Some of you may have heard that trading options is really, really risky and you better avoid them. Others of you may be curious because you may have heard that options can be a useful tool to protect your positions in times of volatility and uncertainty. And all I can say is the answers to the above are yes, yes, and yes. The options can be traded in many, many different ways, but it doesn't have to be a super risky enterprise. Options can be traded very conservatively also. So let's get right down to business and get started with our basic class on getting started with options. All right, so good morning and thank you to those of you who have already typed into the chat. Good morning, Juan. I'm glad that you're happy to be here and ready to learn. What I'd like to ask of the people that are already on board live with us today, and I'd like to applaud you for being here, whether you're joining us live or we have hundreds that listen to the recording every week. What I'd encourage you to do is just type a Y into the chat if you're relatively new to trading options, just so I know who I kind of have with us. And N, if you already feel like you understand the basics, but you're here just for some reinforcement. So if you could do that for me while we go through these important disclosures, I'd appreciate it. You can see in big bold yellow here that we now have Twitter handles, each and every coach. Mine is _Armstrong_TDA, and we're posting on a daily basis. So if you'd like to follow us on Twitter, we'd love to have you on board. So today, Friday, August 16th, it's been a really interesting and somewhat wild ride in the market this week, and I'm glad that you are here to learn. So hello to Ainsley and Josie and Marcia and Anne, and all of you guys are saying you are brand spanking new. So thank you so much for forging ahead with this. Okay. Know that options are not suitable for all investors, as there are special risks inherent to options trading that may expose investors to potentially rapid and substantial losses. Option trading privileges are also subject to TD Ameritrade review and approval. So if you're using Thinkorswim and trading like a ninja on paper money, first of all, know that all of those same trading privileges may not be available on your live account. The second thing is, just because you can trade like a ninja in paper money doesn't mean when you go to your live account at a later time, you'll get the same results. Why? Because as we've seen this week, day to day, the market continues to change. Know that in order to demonstrate the functionality of the platform, we need to use actual symbols, and we do. However, TD Ameritrade and myself, we do not make recommendations, nor can we begin to determine the suitability of any security or strategy for an individual trader. I have no idea of what your goals are, of what's already going on in your account. So any decision you make in your self-directed account is solely your responsibility. Know that there are transaction costs affiliated with trading, and that we've got to take that into account when we place trades as well. When we look at probability analysis, whether it's looking at one of the Greeks like Delta, or we're looking at the Theo Price tab, which we do sometimes, know that those are theoretical in nature, not guaranteed, don't reflect any certainty of an event occurring, and as stock prices change or indexes change, these probability analysis tools will reflect different numbers as well. So we have to take that into account. While this webcast discusses technical analysis, other approaches, including fundamental analysis, can provide a different perspective. And all investing involves risk, including the risk of loss, my friends. Delta, Gamma, Vega, and Theta. Oh, wow. What do I mean when I say that? These are affectionately known as the Greeks. And although you don't have to learn another language, these four measures tell us how price, time, and volatility will impact are options trading. And as you get more into the world of options, you'll come to understand these better with each and every week. As I said, my name is Barbara Armstrong. I came to TD Ameritrade in 2011 as a client. And the reason I tell you this is because I remember what it's like to be brand new. I remember what it's like to be drinking out of a fire hose on a daily basis as I tried to figure this stuff out. But I came to TD Ameritrade because they offered all of this amazing education, and I wanted to become the master of my own financial ship, so to speak, and I was determined to figure this out. So when I give you advice on, being new, trust me, I remember how it feels. But I decided that I would find at least 1 hour a day, 5 days a week to start learning. And I'm going to give you some guidelines on how you might want to begin in just a minute. So I now have been at this for over 8 years. I never expected I'd be on this side of the camera, but I'm pretty passionate about helping people figure this stuff out. So one thing I want to say, and hello to Robert and Michael and Camilla, thank you so much for typing into the chat. One thing I'd encourage you to do also, if you have a question, don't think that it's a dumb question and you shouldn't be asking it. I'll repeat it for those listening on the archives. And if you're posing a question, chances are there are 10 or 20 or 50 other people who are probably asking the same question in their mind. So do everyone a favor and go ahead and post it in the chat, and I will answer it, given the time that we have together. The other thing is this is an introductory level class, but having said that, I was talking to a couple of interns who've been with us over the summer, and they've tuned into a lot of the webcasts, and what they found very helpful was to go through the course first. And so you may say, oh, is this a bait and switch if you're listening on YouTube? And no, it's not. But TD Ameritrade, they're free. So, but if you need to open an account with TD Ameritrade, now you can put $50 or $100 in that account, and then you have access to all the courses and videos and, in addition to everything that you're seeing online as well. And I just encourage you also, if you are watching this on YouTube, if you could like it, and then if you could subscribe to the channel, that would be fantastic. Okay, so we teach this class in about an 11-week rotation, and we have got 10 different strategies that we cover. And this is just in the intro to options classes. And you're saying, whoa, just a minute, back the truck up. I thought there were only, two types of options, puts and calls. And you are absolutely right, my friends. There are two types of options. There are puts and there are calls. And we can buy or sell a put and we can buy or sell a call. But we can put them together in all different types of combinations. And in this introductory class, we're going to cover 10 of those. There are dozens. And one of the mistakes, and yes, I'm going to say it was a mistake. One of the mistakes I made was I did the introductory class, and what I'd recommend that you start with, so if you're watching this today, I applaud you for that, but if you haven't done the course, I'd highly encourage you to start with the stock class, because every option we look at is we're buying a put or a call on a stock, on Apple, on Facebook, on Tesla, on, I'm just picking names out of the air, names that most people will recognize, on IBM, on Coca-Cola. So it's based, we're making our decision based on what the underlying stock or index is doing. So it's important to understand stocks as well. So I'd recommend start with the stocks course and understanding stocks and how they move. And understanding how they move is called technical analysis. So there's a couple of stocks courses. Start with the stocks technical analysis and then do the basic options. So at the end of basic options, you're going to see we've got about 10 strategies here, right? So today we're looking at the basics, but we've also got, buying calls and puts. And then we've got two types of covered calls, covered calls and something we call buy rights. We've got selling cash secured puts. We've got 2 types of credit spreads and 2 types of debit spreads. And then buying a put to protect a stock, a position you're already in. That's called a protective put. So the mistake that I made was trying to trade in my paper money account all of these strategies after going through the introductory class. I'm begging you, do not do that. This is the voice of experience. So what I'd encourage you to do is come every week over the next 10 or 11 weeks. And I look at this as a toolbox. And we've got all these different tools in here, but we can do a lot of damage with a skill saw if we don't know how to use it properly. So what I'd encourage you to do is look at what your goals are and your account size and what you want to accomplish. And after you've had an overview of each of these, pick 1 or 2. 1 or 2 max, and then start trading those in your paper money to practice on a daily basis until you understand that strategy cold. Until I could go to your house and wake you up in the middle of the night and ask you what your rules are. When are you getting in? When are you getting out if the trade goes for you or if the trade goes against you? And what are you going to do if it gets stuck in the middle? So there are entry strategies and exit strategies, but there are also kind of middle management strategies as well. What are your rules around position sizing and managing your risk? So there's quite a bit to this. So hello to Michael and Camilla and Javi and Misarashi. There's a question saying, do you have a rule of thumb when looking for an option trade? And yes, so we're going to look at some of those this week, and next week we're going to go into more detail on how do you choose which of these trades is the most appropriate given what the market is doing and given a couple of other parameters. So, there's a whole thing that people who trade options on a regular basis tend to look at. Okay, so I've got a blank screen up here, and it's not because I'm not prepared. It's because one of the things that I had to wrap my head around when I first started, and that can be challenging for all of you, is just understanding what it really means to buy and sell puts and calls. So, and the reason that I like to do this by what I call natural master rather than having a snazzy slide already prepared is that I want to encourage you to, when you're sitting down and waiting for somebody to come downstairs because you're heading out the door. So here we have our calls and our puts, and we can buy and sell. That you can flip over an envelope if it happens to be sitting on your kitchen counter, or you can grab a scrap of paper and start filling out what I call the 4 grids. And so what am I doing? Well, the first thing we have to recognize, like I said, we've got puts and calls, and we can do 2 things. We can buy them or we can sell them. So as we start going through this, I want you to type into the chat if you know which are the 2 bullish strategies. So we've got 4. We can buy or sell a call, buy or sell a put. Which are the 2 bullish strategies? Because we're going to do those first. So if I buy a call, which direction am I anticipating the stock to move? And if you can type that into the chat as well. I'm expecting it to move up. So what does it mean if I buy a call? And this is the first grid is, what does it mean if I buy a call? Well, if I buy a call, it gives me the right, not the obligation, but it gives me the right to buy the stock at the strike price that I have chosen at any time between now and the expiration date I've selected. So it gives me the right to buy. My expectation is that the stock is going to go up. So how does this make sense? Well, if I'm buying a stock, let me just change the color here. So if I have a stock that's been coming up like this, and it comes down, and let's say it's currently trading at 95. So if I buy a call at 100, and it's now today looking like this, like it's moving up again, my expectation is that something in motion will continue in motion and that it'll continue to go up. So if I've bought this for 100 and it goes up to 110, and let's say I paid $3 for it, well, I have the right to buy it at 100. So now my option by definition has to be worth at least $10 because I could buy the stock at 100 and sell it at 110. So it gives me the right to buy. And my expectation is that it's going to go up in price. Okay, now what's my risk when I'm buying a call? Well, the most I can lose, so this is risk and reward. So what's the most I can lose on a trade? Well, the most I can lose is the premium I paid to get in. And how much is my potential reward? It's unlimited. Sky's the limit. Well, that sounds pretty sexy, doesn't it? And while so you could have a 200, 300, 50, 30% return, but the stock has to move up, and it has to move up in the time frame you're expecting. And my last bucket is time. So is time my friend when I'm buying? Alas, my friends, and these are calls and puts, no. Time is not my friend, because as we approach expiration, we have two components to the value of an option. There's the intrinsic value, or the amount that it's in the money, and then there's time value. And so as it approaches expiration, time value falls off. The strike price is the price that you're allowed, that you have chosen that you can buy the stock at. So if my strike price is 100, if it's currently trading at 97, this strike that I've negotiated, I'm allowed now to buy this at 100. Or I have the right to buy this at 100. Okay, so now the other bullish strategy is selling a put. So when I sell a put, I'm expecting that the stock is going to be bullish or at least neutral. And when I sell a put, I am committing or obligating myself to buy. So again, if I'm using this same example and it's trading at 97, let's say I come down here and I sell a put, I sell a put at 95. I'm going to sell it below where it's currently trading with the expectation that it's going to continue to go up. And so if I got paid $3 for that put I sold, what's the most I can make? Well, the most I can make when I sell something, and this is my sell side, when I sell a put, the most I can make is the credit or the premium that I got paid to get in. And how much can I lose? Well, if I sold a 97 put, I can lose. Now, what are the odds that the stock is going to go to zero by our expiration date? Not high, but it's possible to lose the entire amount of this strike price less what I got paid. So your potential for loss is huge because you're committing to buy the stock at 97. And so if the stock, instead of it going up, if it tanked and fell down to 90, well, you've committed to buy it at 97. So it's the strike minus the premium that you got paid or the credit you got paid to get in. Okay, so, and then is time my friend? Well, when I'm selling, what I'm doing is I've sold something, I got paid $3 for it, and I want it to expire worthless. So my expectation is that it's going to decline in value. So time is my friend, because as it keeps chipping away at the value of my option, I've sold it for $3. I'd like it to expire worthless. Does this make sense? Okay. So now on the bearish side, when I see a stock, and let's say it's falling in value, and it's just come up and it started to fall again. Well, if I buy a put with the expectation that it's going to continue to fall, so let's say it's currently sitting at 97, and if I buy the 95 put or the 96 put, my expectation is that it's going to continue to fall. And so if it continues to fall, let's say I paid $3 for this, and if it continues to fall and it goes down to 85, which is quite a fall, but then this would have to be worth at least $10, right? Because I have the right, when I buy a put, to sell it. I have the right to sell it. So I have the right to sell it at 95, even though it's trading at 85. So I'm going to come up and I'm going to do this in blue. So bearish is blue. So now I have the right to sell. Does this make sense? As I used to say when my kids were little, capiche? So we're expecting the price to fall, and investors expecting the price to fall. And what's the most I can lose? Well, it's pretty similar to when I buy a call. The most I can lose when I'm buying is the premium. And the most I can lose, well, the most I can lose, again, it's huge. The most I can make. So the most I can lose is the premium. The most that I can make is, well, I would say it's huge, but to be absolutely correct, and although it is a huge number, we take our strike price minus the premium. Because technically, are the odds high that it would ever fall this far? No. But it could fall to zero. And if it fell all the way to zero, that's the most we could make, is the strike price minus the premium we paid to get in. So if it fell to zero from 95, we could make $92 a share because we paid $3 to get in, so we'd have to take that premium off. So that's our max gain or our max reward. And then is time our friend? When we're buying, time is never our friend because it's chipping away at the value. So if we have this stock and it doesn't end up continuing down and it just goes sideways, if at expiration it's still at $95 a share, well, so what if I have the right to sell it at $95 a share? If it's trading at 95, that doesn't give me any advantage, so my option would expire worthless. So, it has to move, and it has to move in the right direction. So when I asked if this made sense, Michael typed into the chat, the buy did, but I need to understand the sell a little better. And my friend, this is very, very common because it's not intuitive for us. Like the sell, I always had to think this through. So when we go to the call side for the sell, and some people will sell what we call a covered call. What is this doing? It is giving us, what are we obligating? So this is, remember when we buy, we have the right, and if the trade doesn't go our way, we can walk away. The most we're going to lose is the premium. When we sell, we are obligated, and in this case, we're obligated to sell. Now, if we don't own the stock, wow, that could be tough, because if the stock goes up and we've bought a call at 100 and it goes up to 110, if we've sold a call at 100 and it goes up to 110, we are obligated to sell at 100. So we'd have to go out and buy it at 110 and then sell it at 100. And if it went up to 120, we'd have to go out and buy it at 120 and sell it at 100. So there's a huge amount of risk. How much risk? Well, our risk is unlimited. Our risk is unlimited. And what's our reward? Sorry, on this one, I'm doing risk first, so our risk is huge. Our reward, the most we can make when we sell something, is the credit. So, and our reward, our max reward, is the credit. So if we sell a call for $3, that's the most we can make. If we sell a put for $3, that's the most we can make. And there's more risk. So why would people do that? Well, if our expectation, so why would somebody sell a call over a stock that they own? Well, maybe it's busy going sideways, and so it's not appreciating in value, but maybe it pays a dividend. Or maybe they're expecting, it to maybe pull back a little bit, but they still want to own the stock. They don't want to sell it because they bought it 8 years ago and it's appreciated a lot in value, and they don't want to have to recognize that gain. Like, there are lots of different reasons people might want to sell a call. It might just be simply they want to add some additional income as the stock is busy going sideways. But if it goes up through their strike, you can be called out and forced to sell your stock at that price. And if it goes up to 110 and you own the stock and you sold the 100 call, tough ganazzos. You've just sold it at 100, or you'd have to buy that call back and pay more for it than the $3 you were paid when you got in. Now, is time our friend? Yes. So, these are the basics, and what I really encourage you to do is practice this until you can draw this so quickly it's like falling off a log. Okay, so I want to quickly go out to the Thinkorswim platform. I have a stock called Amgen up, and Amgen is, if you're not familiar with the stock, you can come over to the Analyze tab. And if you click on fundamentals, we can see it's part of the healthcare sector. Analysts rate it strongly. And we're not going to look at the fundamentals now. But in this week where so many stocks technically, had a really rough week, Amgen seemed to still have a pretty strong week. And this pattern here, actually, I'm just going to do it this way. This pattern is called a bull flag. And what we're seeing here is today we have a bounce, or it's moved above the high of the low day. So we call that a close or a move above the high of the low day. And so if we wanted to buy a call, or be, another trader word for that is go long a call, but in plain old English, we call that buying a call. We can come out and look at the trade tab. And, many investors will say, well, or traders will say, how long do I expect it to take to make the move? And then they'll add at least 3 weeks to that. So if we came out to October and bought an at the money call, one of the things that many people look for is, are there other people trading this strike? So I had a question earlier saying, what is the strike price and what is the premium? So this is known as the strike price. So if we bought the 210 strike, what does that mean? It means we have the right to buy Amgen at any time between now and the expiration date, which is 63 days from now, October 18th, at $210 a share. And it's currently trading at $205. So it has to move up a little bit. It's got to move up $5 a share for us to be in the money on this. And what are the odds that it will be in the money currently? This is an estimate. On expiration, you have about a 40% chance that it will be trading at $210 a share or higher on October 18th. So let's just go and buy one call as an example so you can see that. We are going to buy a single. How much are we risking? So if you know that, go ahead and type it into the chat. How much are we risking? And how much can we make? So what we're risking is this price that we're paying, and there's always a multiplier. It's typically 100 shares. So we're risking $550 on this. How much can we make? The sky's the limit. If it goes to $2.20 a share, we're up $10 a share minus the $550 we paid to get in, so we're up $450. If it goes to $2.30, we're up $14.50. Robert, I will cover that next week because we are currently out of time. So Robert asked the question, how do you add items like volume and delta? You come up here to the layout tab, and you can customize your layout tab to add whatever you want. There's a customize button here. So you can hit customize, and if you want to add delta, you just come here and then click on delta and add. So we'll talk about that a little bit more next week, and we'll talk more about strikes and volume and open interest. This is the Thinkorswim platform. So we're going to come to confirm and send. We want to buy one 210 call expiring October 18th at $550. How much can we lose on this trade? Max loss is $550. What's our max potential gain? It's unlimited, infinite. There will be a transaction fee. In paper money, it doesn't always reflect what it is in your live account, so you may want to check on that. And we can send this in. You could put this in your long call bucket if you have one, or buying a call bucket. And there we go. So guys, our half hour, it has come, it has gone. I hope that you have found this to be helpful. I highly encourage you to pick up a blank sheet of paper, draw those 4 grids, time, what direction are we expecting it to go? Is time our friend or enemy? What's our max reward and what's our max risk? And what does it actually contractually mean when we buy or sell a call or put? So, and then where do we go next? Well, as I mentioned, the courses. The stocks technical analysis and trading options are a great precursor to this, or a great complement to this. And then guys, practice, practice, practice. So we just did one trade on Amgen today, but bring up the list of stocks on the NASDAQ and on the Dow 30, and there's 130 stocks that you can quickly click through, and I'll show you how to do that next week also to look for setups. And then you may want to watch this archive again. I'm going to talk more about Cameron May's class next week, but there's another class that was recorded on July 5th called Getting Started with Options. Sorry, I've got a hair in my face. What I wish I had known earlier, and you may want to check that out also. So the question, there's one last question. Can I day trade options? And it is possible to place an options trade and get out the same day. But that isn't the purpose of the strategies or the intention behind what we're teaching in this class. Although many of these options trade will be of shorter duration. So my friends, thank you so much for being with me today. Let me get rid of these. And just in closing, I just want to bring up one last screen. Okay, so just in closing, know that this software application is for educational purposes only. Successful virtual trading during one time period does not guarantee successful investing of actual funds in your live account on a different day, because the market continues to change. Also know that although we use real symbols today, that is not to be construed as a recommendation on the part of TD Ameritrade or myself, Any investment decision you make in your live account is solely your responsibility. So with that, my friends, farewell. Have a fantastic day. Thank you so much for joining me. Enjoy your weekend, and I will look forward to seeing you next week for more on the basics of trading options. Take care, everyone. Bye for now.